All right, so welcome to another video. Today, what I want to do is share with you some concepts about trading option leaps and what most people just don't know and don't understand, and some things you probably should know when it comes to trading option leaps. So I want to put those kind of in the foreground for you because a lot of people try to use option leaps in order to trade them more kind of like a stock substitute without using as much capital. And that's what we're going to go ahead and kind of cover in this video and episode. If you definitely want to check out some of the things we have on our website, including some of the live classes, check out the Traders Fly website. There's a lot of live classes that I do. You can always purchase the old live classes as well, like ultimate adjustments, portfolio construction, monthly income for covered calls, single options, and there's many more classes there as available as well. So definitely check that out. You can also take a look at some of the things I do in the channel for Discord, which is kind of like a chat room, but I also post some charts there periodically where things you might want to look for, support, resistance, and that kind of stuff. Okay, let's take a look at trading option leaps, because I think a lot of people enjoy this strategy from a thought process of, hey, I like the idea, I like where it's going. So that's where they get interested in this strategy, is option leaps. So option leaps is basically buying an option longer dated, and they think of it kind of working and functioning kind of like a stock substitute. So if I was to go out and buy 100 shares of Microsoft here as an example, and we can go in and just change this to 100 shares. I can say, okay, well, the stock costs me $281. If I go ahead and try to push that order through, that means I would pay up $28,000 roughly for that stock. Okay, so that's for 100 shares. But instead of paying up $28,000, what I could do is do a substitute and go into kind of the option side. And by collapsing all these options, you can see there's a lot of days and dates here. So by looking at this, I could go out as far as here, by the looks of it, about 795 days. But let's just say we go about 300 days. So that way time decay is not as big of an issue. And what we can do is go just a little bit out of the money. We could go right at the money, but just a few points out of the money. And let's just go in and buy now our single option, and then we'll go in and try and purchase this one. We'll double click it, and what you'll see here on the cost of this, it's a lot cheaper. It's about $2,500 for controlling 100 shares of stock. And that's because the option is $25.20 times 100, and that's where you get the $2,500 for that option premium. Now, your theta decay on this is not that bad, right? Because every option expires or decays, and you're losing about $4 to $5 per day where the stock just kind of stands still and hangs out. So that doesn't sound too bad. So what people do is, hey, I could use $25,000 or sorry, $28,000 and buy the stock, or I could do $2,500 and just get the option, and I'd get kind of a similar effect. Well, yes and no. Keep in mind the option that we've purchased here is a 45 delta. So it's kind of like buying 45 shares of stock. The 100 shares of stock are actually hard deltas. So that's kind of like getting 100 shares of stock. And every time that stock moves up $1, you make $100. Whereas it moves down $1, you lose 100. Whereas with the single option, you're only at a 45 delta. And because you're at a 45 delta, when it goes up, you actually are only making $45. And you're also losing a little bit of theta. So now I wanted to give you a quick shout out from our sponsor. Before you make any trade, you can verify it with VectorVest. Their free stock analysis report tells you what a stock is really worth and how safe it is. And it even rates it whether you should be a buyer, seller, or hold the stock. So that way you can invest with confidence. If you're interested in VectorVest, check out the link in the description below or visit the website vectorvest.com. Now, the thing that most people do not get when dealing with these leaps is this, what I'm going to tell you right now. And that is, they don't understand that dealing with a longer dated option like this has a huge implied volatility behind it, or in other words, a big vega. Because if you take a look at the vega that we have here, it's actually your biggest Greek. And this is what most people don't get, is look at your delta. It's 45, gamma 0.4, nothing. Theta, you're losing about $4 or $5, but the vega is huge. The vega is actually 105. So trades that are longer in duration have a huge vega implication. They have a huge volatility component behind it that most people just do not understand, because volatility itself is complicated. But the more time that you kind of have, it's the more vega that's in these options. So now, as the stock price goes up, Okay, what happens to volatility as stock prices head higher? Volatility actually compresses. There's less fear in the market. So volatility subsides, it goes down. And when volatility goes down, these options start losing money. So let's go ahead and move this volatility lower. And look, we're losing for every 1 point in volatility, we're losing about $100. And it's the biggest one. And look at our profit and loss right here. As we keep going down, for every 1 point in volatility, we're going to lose about $100. And you can see if the price of the stock keeps heading higher, we will lose volatility because now people are more calm and they appreciate the upside move. But that also means less people need the options. So when you're buying a single call and you're looking for that stock price to head higher, you have a lot of positive vega. And in fact, it actually works against you. So think of it this way. That stock price heads higher. Not only do you lose some time value in theta, but now volatility keeps compressing lower and lower and lower and lower. And you're just constantly playing catch up in these because the volatility is so high. So this is one thing that most people do not get and understand, is that the vega is just so big that it can actually work against you by buying such a longer dated option, especially if volatility just all of a sudden drops and the stock skyrockets. Volatility is going to drop in a big way, and all of a sudden your option premium, even though you've chosen the direction correctly, you might actually lose money on it because of the vega. It's just so big when you're doing with longer duration options. So what would be a better approach? Well, what you could do is actually trade something more along the lines of something between, let's say, if you want to do longer dated options, you could do something between, let's say, 80 or 90-day options to about call it 200-day options. And that'll give you a lot less vega than maybe a 333. Yes, you'll still get quite a bit of vega, but you're not going to get as much. You'll probably cut that vega down by, 30, 40%, maybe even by half, but you'll cut it down quite a bit. So somewhere around this level, you could just trade the 150-day option and then go ahead, and once these 150 days get to about 60 days, go ahead and reset it back to 150 days. And now you do it 2 times and you'll be able to get your 300 days. Now you might say, well, but it's not 300 days. Well, that's okay, because remember, if you're a long investor and you're buying a stock, well, if that stock continues to head lower, 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 you'll probably still hold on to it, right? So in the same way that when you're dealing with longer term dated options, all that you're doing is just like, look, if you have a longer dated option or a single call and you're down over here, let's call it $1,500, well, you'll probably still hold on to it. Okay. All we would do is just go ahead, and as this pulls back, you're just resetting that position again, and you still be down that money. You're just resetting it at that same point in time. The big loss happens is like when you don't get into the position right here, and then it explodes and we're not in the position. But if you were a long investor and you were holding a stock, like let's say we go to Microsoft over here, okay, and here we take a look at this downward move that we've had, right? So if you're over here a long investor, it goes up, it starts pulling down. As long as you're still holding, you're okay, right? Because then eventually you're looking for that move to come back up. But if you got out of it and then you didn't get in until way later, you missed that whole big move. So our point, whether we're a long investor and we held through this move and we had 100 shares of stock, or we had a single call option that we held through on the downside, you'll lose money whether you're holding stock or whether you have a single call option. You would still be losing money. As long as you hold through that and you're looking to weather the storm, then you still will make money on that upward move. So what all we're doing is that you could just reset that option when it gets down to, let's say you're dealing with a 150-day option, just reset when it gets to about 60. Now you might say, why 60? And this gets me to point number 2 of what most people don't understand about trading options. The 90 to about 200-day options function a certain way, in the same way that, let's say, the 10-day or less options focus a little differently. 15-day to 30 days function a little different. So you have these different baskets where they function a little bit different than kind of the other spreads. So what you want to do is kind of reset it in the same bracket. It's kind of like if you've got a van and a truck, they function kind of similar compared to like maybe a hybrid or a motorcycle. They function completely different. Whereas here, if you're dealing with a 200-day option, it's good to reset these when they get to, 90 days, because now the 90 will still have quite a bit of premium like the 200-day. What you don't want to do is take the 200-day and reset it when there's only got 15 days to go, because what you're doing is you're taking that 200-day option through a really tough theta. Through, if you're buying a single and you're going from a 30 to the 15-day, you're going to run it through a very difficult time when the theta is really burning quickly. So most people don't get that. So work in the same range or bracket that you're kind of working with in your options. So if you're dealing with like 20 to, let's say, 40-day options, and they get down to, let's say you got a 40-day and it gets down to 15, you can reset it back to a 40 when it gets to about a 15. But you don't take like a 40-day to like a 5-day option and try to get it to expire. I mean, you can if you're going really wide and if you're playing like a low delta, and maybe that's a different strategy. But if you're trying to get the option to behave very similarly, then you'll take that 40-day and you'll probably reset the concept around 15 or 20 days. If you're dealing with like a 150-day option, you might want to reset it, around that 60 to 90 day. If you're dealing with like a 300-day, even if you want to do it, I wouldn't recommend it, because just getting into those positions is a little more difficult. Market makers don't like them. They don't want to deal with them. There's just a lot of volatility that they have to offset with stock. But you might want to reset it when it's about 120, 150 days, because then they'll still function and behave similar to the 330. So anyways, my point is it's not bad to just reset your position and trade, somewhere, 200 days or less, and just kind of rework those positions and reset them, rather than trying to trade way further out here. And then, and then try and hold them for a long period of time. Instead, doing something around that 150, 200 day is usually better off. And I'm sure you could find like one day out of that month to reset those positions, because then you don't have that huge implied volatility or a huge vega component working against you in some cases. So be careful with these single leaps, even though it sounds like a great concept and a great teaching concept of how to, trade them and sell against them, or you buy longer dated, you don't have to worry about it. It's like buying a stock. The reality is there's a huge vega component that just most people don't get. That vega can work against you if that stock's heading higher. And then this line, the white line, which is T+0, that's your current line or value, will start actually moving against you as the stock actually grinds higher. And all you're doing is, as that stock keeps heading higher, volatility actually keeps decreasing. And as it's decreasing, you're constantly losing money. And then again, it's trying to go higher. Okay, so here we've got, it's trying to go higher. And then again, volatility keeps going down. So you're playing this $0 of profit and loss game. You're also losing some value on theta. And then again, it tries to go higher. And it's just playing this cat and mouse game of like, man, I'm just keep losing money, or I'm not really profitable, because it's what you need for these trades to work out when you're dealing with the single options like this. You actually need them to explode in your favor or in your direction very quickly and very rapidly. And that's when they profit fairly well. Otherwise, they are expensive from a vega standpoint. And usually it makes more sense to trade something a little bit more shorter dated, maybe between that 60 and 150 days. Even if you want the longer dated, just take that 150, 180 and just kind of reset it when it gets to maybe 60 or 90 days. Get that 30 to 40 days out of it, and then just reset again to the 180, 190, 210 days. But going way out, 360, 450, 700 days, it's just, you're stacking on a lot of vega that just most people don't get and understand. So anyways, there's a lot more discussions that we could talk about in these kinds of trades. They can go much deeper, and this is something that I deal with in my coaching session. So check out the website there if you're interested to get a one-on-one coaching session. Go to tradersfly.com and you can check that out, or take a look at the live classes that I offer as well, where we dig deeper into certain strategies when it comes to options, especially if you're brand new. It pays in the long run to get a course that's detailed, so that way you're not burning money on your trades. Start with some paper trading, get some good concepts and things under your belt, and then get some practice in, and then that way you can at least have some decent knowledge to going into some trading as you continue to evolve your skill sets, knowledge, and comfort level when it comes to your personal trades. Anyways, thanks for joining me. Enjoy the rest of the week ahead, and I hope to see you in one of the future classes that I have, maybe a one-on-one session or on the Discord channel. Thanks again. I'll see you next time.